Hello, my name is Jingonelli, and today we are going to be looking at another tutorial. But before I begin off, make sure you subscribe to the channel. It will bring you some good luck in your forthcoming exams.
The assertions for PPE. Why we audit PPE? Objectives of auditing PPE. Now, after knowing why we're auditing PPE, because your audit manager will ask you, why are you auditing PPE? I want to verify completeness. I want to verify rights and obligations. I want to verify whether these assets we are recording, we own them, or if it is substance over form, we're the ones who are using them. We have control over them. We are recording the correct amounts. Those assets do exist, because sometimes they record assets, but they don't physically exist. And then also whether they are presented in line with the standard, and also necessary disclosures have been made. The other thing we do during planning is which document you ask for documents. So which documents should we ask from the auditee? Do we ask from the auditee in order to audit? Which documents do you want to look at? So while you're planning, you list those documents and you ask them from the financial manager. Financial manager must give you these what? Documents. That's the person you're auditing, the company you are auditing. So which documents should we ask for? We can brainstorm. When you're auditing PPE, when you're auditing assets, which documents should you ask for? Yes, Ronnie?
I think we can ask for PPE schedule.
PPE schedule, yes. Next, what else?
Insurance policy acquired.
Yes, insurance policy. What else? Receipts, yes.
The control of the assets.
Control of the assets.
The documents that we ask for, we can ask the auditor for it.
Invoices.
Yes, which other documents do we ask? Asset register, yes.
Yeah. Then PPE. I mean, no, IS 16.
Yeah, you need the standard and the original text. You need the original text of the standard. You need the payment voucher, logbooks, yes. Okay, you people, you seem to know the documents we need. So we need, if we can arrange them here, we need previous years financial statements, audited financial statements. And the ML. Do you know the ML? Who knows ML? ML is management letter. So you ask for the previous year's audited financial statements and the ML. ML we covered it in top 4, the management letter. Management letter will be having issues that remain pending in the previous year. And you want to check whether these issues have been now settled. Have they been resolved? In the last year's audit, there were issues over assets. Have they been settled or they are still pending? So that's why you need the ML. Then you also need the draft financial statements for the current year, the current financial year. Remember when we got audit, there are no final financial statements. I said ML is the management letter. You covered it in topic 4. You need the draft financial statements for the current year. I call them draft because when you go to audit, even if they have completed preparing them, they are still draft. They only become final after you have signed your audit report. Remember, the auditor doesn't sign on the financials, but you go through them and confirm them, and then sign your audit report. So before you sign your audit report, they are still draft financials. They only become final after auditing them. You need the general ledger, trial balance. This is what we do practically when we are auditing. You need the general ledger for PPE and related accounts. You need, somebody told us we need the asset register. Somebody told us we need the PPE schedule. Then we also need the insurance policies, since these assets must be insured. The insurance policies with the insurance companies will show us evidence that assets were insured. Somebody told us we also need the revaluation reports. Some assets may have been revalued during the year, so we need the reports from a qualified valuer. Then we need list of disposed assets, disposed and acquired assets. Some assets were disposed, others were acquired, so we need that list. We also need the list of assets with third parties. The assets of the entity, but with other people. You find like the assets of Mubza are in Chambogo. We need that list. We also need IS 16 and other standards we need the original text. Last time, I think I showed you how to get the original text of the standards from IFRS Foundation. So you go to IFRS Foundation website. You download the original text of the standard. I can show you the original text here of the standard of IS 16. So you just go to IFRS Foundation. Even you can go there, you create an account. Then you go to where the standards are, you download them, the original texts. I can show you how it looks like here. For example, IS 16. This is the original text of IS 16. It is 28 pages. So you see the original text of the standard. It was made in 2021, in 2001, sorry. But first time was 1993. So this is the standard. They give you the background of the standard, where it came from. This is the background of the standard. Now this standard, the way it is arranged in paragraphs. This is the table of contents. You find objectives of the standard, scope of the standard, definitions, recognition, initial cost, subsequent costs, measurement at recognition, measurement after recognition, all that. The recognition, effective date is here, all that. Now, for example, when you're auditing PPE, you're going to come and read this text. And they are different. For example, paragraph, let's see, for example, paragraph, these are the paragraphs, so these figures you're seeing here. They keep reviewing them, that's why like this one was deleted, yeah? It was deleted, they reviewed the standard, they removed that. So for example, if we go to paragraph 7, you see paragraph 7, it says that the cost of an item of property, plant, and equipment shall be recognized as an asset if and only if it is probable that the future economic benefits associated with the item will flow to the entity, and the cost of the item can be measured reliably. So now, if you are auditing and you find that the auditee has not followed this, he recorded the asset before it was probable. You get it? So you're going to record and say, paragraph 7, this is how you write your findings. You say paragraph 7 of IS 16, you quote this paragraph. Paragraph 7 of IS 16 states that the cost of an item of property, plant, and equipment shall be recognized as an asset if and only if it is probable that future economic benefits associated with the item will flow to the entity, and the cost of the item can be measured reliably. However, the auditee ABC Limited recognized the property and plant and equipment before before its cost could be measured reliably. Maybe they recognized an asset before they even received it from the client, from the supplier, before they even bought it. They were just still planning to buy it and they recognized it. So it was not yet probable. They didn't have the asset. So they are overstating assets, you get it? So you first quote the paragraph, then tell us, however, the client did this and this and this, like that. Did you give us the implication and then the recommendation? They will prepare management letter. Even here, we prepare it the same way. Now, that's how you write as a student who has passed through my hands. So there are many paragraphs in this standard. For example, there's a paragraph, paragraph 17 is about direct attributable costs. Which costs do you include in the cost of property, plant, and equipment? They tell us you put the cost of employee benefits, for example. So these are examples of directly attributable costs. For example, if you're constructing a building yourself, you're going to capitalize cost of employee benefits, the workers who work on the site, those who are constructing. So when you're getting the cost of the building, you add the wages you've paid them. You add the cost of site preparation, the initial delivery and handling cost, installation and assembly, cost of testing the machine or building, the professional fees. So these are costs which are supposed to be included. But you may find somebody has included VAT. VAT is not capitalized. For example, when you buy a machine, you don't capitalize VAT. So I said, paragraph 17 of IS 16 requires capitalization of directly attributable costs, such as this, and this. However, the auditee procured a machine from Japan and capitalized value added tax. You put the implication and the recommendation. So what am I saying? You must have the original text of this standard. You're not seeing any figure here. This standard only has rules, 28 pages of rules. So as an auditor, you must have these original texts when you're auditing. So we're still planning to audit non-current assets, and we have said that we also need IS 16. What else do we need? What have I not put here? Those who are brainstorming, what have I left out? You need ownership documents. You ask for them to. For example, to confirm whether the entity owns the land, you need to look at the land title. So you need ownership documents, e.g. land title, logbooks, etc. Then you need, for the assets you have purchased, you need supporting documents, supporting or source documents, e.g. LOPOs, invoices, etc., receipts, etc. You also need the finance and accounts manual. For example, this will provide policies to follow on non-current assets, e.g. depreciation rates. You need the budget. You need to find out whether they didn't exceed the budget while spending money on assets. So these are some of the records you need.
The bank statement.
You also need the bank statement, confirm the money they spent on these what assets, etc. So that's what you need. Now, this is what you do practically, because some of you are going to become auditors. You are lucky that you are being taught by the person who practices. So this is what you do. We said you start by planning. You come up with the objectives of auditing that area you're auditing. This morning we are auditing property, plant, and equipment. So you start with the objectives of auditing PPE. Objectives come from the assertions. You want to verify the assertions. Assertions of assets are here, they're in COVEP. Then the ones of incomes and expenses are COCAP, they are here. Then after that, after coming up with the objectives, you list all the documents you need, and those you can get from the client, you request them, you send him an email, your client, before even you go there, you tell him, I'm coming tomorrow to audit your assets, please prepare these records. They'll prepare them for you. You just sample out assets, I'll teach you sampling later on, and then you ask for these documents. These are the documents you're going to verify. Any questions? Okay, we continue. Now, after that, you develop the audit procedures. Develop the audit procedures. So this is a skill you need. If you develop this skill, you're going to become the next top auditor in town. So we are basically looking at substantive procedures, because you looked at the test of controls in topic 4. Substantive audit procedures. Who can remind us what is the first substantive procedure I talked about last time we met?
Analytical.
We start with analytical procedures. How do we write analytical?
Compare.
All about comparisons.
And then what? And analysis, eh?
Yeah.
So we start, what do we compare first?
Opening balances and closing balances.
Okay, compare opening balances of PPE in the current year trial balance with the closing balances the previous year's statement of financial position and the PPE schedule. You see how I'm using these documents? PPE schedule, I'm using it, balance sheet, I'm using it. The PPE schedule to establish any differences. So which assertion are you trying to verify here?
Accuracy.
This will help in verifying accuracy of opening balances of PPE. So you want to verify whether the opening balances of PPE are correct, which we don't expect any single difference in the opening and closing balance, because you closed at the 1st December, you open the 1st January. So ideally there shouldn't be any difference. So if we run this test and we find even if it's a difference of 1,000 shillings, there is a problem. So we don't expect differences in opening and closing differences balances, unless if maybe it was an error and that one will be corrected. So first of all, we run that test and confirm that they carried the correct balances. They carried the correct balances. So what else do we compare? We can also, we said, obtain the previous Now this one, you must learn this from here. You don't have to first read 50 pages of this topic 5 to remember this. You just have to remember the test and know how you write it. So obtain the previous financial years, ML, analyze it, and find out whether all the issues on PPE have been resolved or they are still pending. You audited last year. You gave these people an ML with issues on PPE. And you even gave them recommendations on what to do. So you want to find out, have they corrected what you told them to correct, or they haven't? So that's why you get that letter and analyze it and find out whether they have corrected those issues or they are still pending. What else do you compare? We are still on one test, analytical procedures.
The actual capital expenditure with the budgeted.
Compare the actual capital expenditure. In finance, you call it CapEx, with the budgeted, establish or to ascertain any significant increases which are a sign of overspending the budget. Overspending the budget. This verifies which assertion does this verify?
Valuation and accuracy.
Valuation and accuracy of the values of the assets. So if we come up with a budget at the beginning of the year, we said here in the requirements, we needed a budget. We needed a budget, and so we said that you needed a budget. In the requirement, in the documents we needed, there was a budget. At the beginning of the year, management comes up with the budget. That budget must be followed. We must spend money as per the budget. That's why they put in place. So it is bad practice to start spending money over and above the budget. It is a sign that maybe you're transferring money from one budget line item to another without authorization, and you spend it on that asset. So I'm not saying that we always spend the actual figures. They can slightly differ, and those differences must be approved by the board. For example, you might have budget to buy a machine at 400 million, and you go to the supplier and find when it is 450. That is understandable, or 420. But you find when they are bought at 600, then where did they get the balance? You as an auditor, you first ask yourself, where did they get the additional 200 million? Where did they get the additional 50 million? Was it approved by the board? You get it. It could be a sign of stealing money. Because before they make a budget, they first inquire from a supplier of that asset. how much the supplier is likely to charge. So there's no way an asset that was budgeted at 400 will end up being bought at 600 unless they just want to steal the money. But there can be slight changes. That's why here I'm saying big differences. You only focus on the big differences, yeah? These ones. But the small ones, provided they are approved by the management or board, that's okay. So we compare the actual and the budgeted, and we question those big differences. We ask whether they were approved. We ask why they are doing that. What else do we compare? The ratios. Do we have any ratio for assets?
Yes,
Which ratio?
asset turnover ratio.
So compare the asset turnover ratio. For the current year with the previous year. In the case of big increases, this should be matching with increases in production and revenue. Now, asset turnover, we mean the replacement of assets. You only replace assets when they become old, yeah? Replacement of assets. ROCE is not an asset ratio. It is a ratio for profitability. So turnover, how many times are you replacing your assets? The risk is replacing assets before the useful life. So risk is replacing assets before end of the useful life of the economic useful life. You get it? So if an asset was 5 years and you find that they have replaced it at the 4th year, what is causing that? That means that asset is being overused. That's why it has gotten old so fast. That should be matching with the revenue they are getting from that asset, because we bought those assets to generate revenue. You get it? So high asset turnover ratios are questionable. You can even compare them with the industrial averages and industrial averages. How are other companies faring? Are they also replacing with the same assets? Are they also replacing them at that high rate? Now, here there could be a risk that assets are being used for other works which are not for the company. Risk is there may be risk. A risk that assets are being used for private work. That's why they are getting old so fast. So fast, like that. So you need, as the auditor, you need to find out that for the assets they replaced, did they live their life, or they are replacing them before the end of their life? How are other similar businesses with similar assets faring in the market or in the industry? If you find that our ratio is so high, that's not a good ratio. If you find it slow, then that's okay. What else do we compare? Or analyze. We can say analyze the PPE general ledger and check and confirm that no revenue expenditures are capitalized. IAS 16, you remember you're also supposed to capitalize revenue expenditures. So get that ledger, PPE ledger. Ledger, we mean the list of transactions where there's debit and credit. So get the ledger and confirm that no revenue expenditures are capitalized. This will test which assertion? Which assertion is being tested here?
Accuracy.
Accuracy and completeness.
Test for accuracy and completeness. Completeness, valuation, accuracy, etc. Like that. So there are many other things. We are still just on one test. So Mr. Biaranga can even set for you only on analytical procedures. So you can develop as many tests as possible. We are still only on analytical procedures. So those are some of the comparisons you can make. There are others. Somebody is telling us here that you can compare the expectations of the auditor with what is actually being done. True. Last time we also said you can compare related items. We said you can run reasonableness tests and many other comparisons. So that is it. That is for the analytical procedures. Then we go to the next test. We are brainstorming these things. They're not in any book. We're just brainstorming. So you must learn this skill of developing these tests. It is simple. Just look at which test am I doing analytical. You start with that compare. What are you comparing? You cannot compare what cannot be compared. You need to find out what can I compare or analyze. And then you start writing. When we compare, we want to establish whether there are any significant differences. Some accounts have differences when they over increase, others when they decrease. So, and then which assertion are you trying to verify? You get it. There are three parts. The test, what is the intention? What do you want to find out? And then the assertion. We go, what's the next test?
Recalculation.
We go to recalculations. So what do we recalculate on assets?
Depreciation.
Gain and loss on disposal.
Okay, recalculate the depreciation. The PPE schedule. Confirm what? What are you confirming here? Accuracy, yeah? You can also recalculate
Variation.
increase and you can also revaluation, increase and decreases in revaluations.
Gain or loss on disposal.
So you can also calculate gain or loss on disposal. Like that. So these points are even here. You can look at them here. You just get to know for assets, what do I need to recalculate? For example, this test here, recalculate the depreciation charge. For example, of additions to confirm that depreciations are correctly applied as per the company policy of a pro rata basis or a full year in the year of acquisition. Remember when we have like additions in the PPE schedule, you've added an asset in the middle of the year. You only start depreciating it as per IAS 16 from the date you have capitalized it. If you acquired it on 1st September, so you depreciate it from 1st September up to the end of the year. So that's why you get the rate from the company policy. You get it from the finance and accounts manual here, the rate which they're supposed to use. If it is 5%, you reapply it using the method they are supposed to use and see whether you're getting the same amount. As you have said, you can also recalculate the profit or loss on disposal and agree to the statement of profit or loss. So you get that disposal, you see how much was the asset sold and how much was its value before it was sold. The difference gives you a profit or a loss on disposal. The value of the asset before selling it compared with the amount you sold it. And you check whether that it was posted as a profit or as a loss in the statement of profit or loss. Then you can also recalculate the revaluation increases or decreases and check they are treated in the financials in accordance with IAS 16 and 36 accordingly. Yeah. So those are some of the recalculations you make. So it is simple. Just if you're auditing an account, first find out what am I recalculating. If it is sales, you're going to recalculate the VAT, for example. If it is purchases, you're going to recalculate the VAT. If it is payroll, you're going to recalculate the statutory deductions like NSSF, like payee. If it is inventory, what do we recalculate on inventory? If you're auditing inventory, what do you recalculate?
Closing balance.
Lower of NRV.
You can recalculate NRV. You can recalculate the cost itself. Yeah. The inventory written off and all that. So that's the recalculation. What's the next test? We got the next test. External confirmation, yeah? So the third test is external confirmation. Who can develop for us a test on external confirmation? Before you write external confirmation, you have to find out, is there any external party with assets? When you come to the documents you asked here, we said we need list of assets with third parties and the assets used as collateral. So who can develop for us a test based on this using external confirmation?
Inquire.
How do you write external confirmation first of all? We said you say write to obtain confirmation, or we said you do what? You sexualize. That's for external confirmation. We said you say write to. We said you say obtain written confirmations. And we said that you can also write say sexualize. So somebody should develop for us a test on external confirmations using this evidence. Yes.
Obtain confirmation from the books to confirm if the assets were used as collateral securities.
No, the confirmation is obtained from an external person. So you replace books with an external party.
So circularize creditors to confirm their balances.
No, we are on assets. We are still on assets. The other lady, you replace books with an external party you are writing to.
Write to the bank to confirm the balances in the bank statement.
That's for cash. We are still on assets.
We sexualize to the certified revaluers to confirm their evaluations.
That's the test. Like for evaluation, you're going to sexualize the valuers to confirm the figures they are put in the report, yeah? Yes. Next.
You write to third parties to confirm whether they are holding some of the properties in PPE to test
Okay.
completeness.
No, you are testing existence. To test for existence. Okay, next, any other test on external confirmation?
I think you also write to inquire if the product or the assets were acquired at the exact amount they are recorded.
That one is not so clear. You can also obtain confirmations from the bank so that they confirm that some of the assets are being used as collateral. So that is external confirmation. What's the next test after external confirmation? We go to inspections. Confirmations, sorry, inspections. Assets don't have any going concern. So this one was written to confirm the going concern of the asset. The going concern is for the business, not for the assets. So for inspections, we said you either move forward or you move backwards. And I told you the words to use. So for inspections, inspection of documents, and inspection of assets. So who can develop answer test on inspection of documents? For assets. For example, you can say agree, the asset register, with the, or to the, general ledger, and PPE schedule to verify completeness and accuracy of the assets. This asset is moving forward, this test is moving forward, and it is only having documents. You just need to know the documents in the asset cycle. So the first document there is the asset register. Then you go to the ledger, we got the schedule. So I'm saying agree the asset register. We said here we use the words like agree, match, you're matching, review. We said examine. We talked about check. So I'm agreeing these documents. Whenever you are using inspection of documents, you only use documents. So agree the asset register, the general ledger, and PP schedule to verify completeness and accuracy of the assets. Now, this test can also be moved backwards. For example, you can say agree the amount of PPE in the statement of financial position to the general ledger, the trade balance, and general ledger. Under assets, register. Confirm existence of the asset. Like that. But you can also check whether, for example, for the leased assets, you're going to check whether the finance lease agreements are matching with
Annette, please.
payment schedule.
Annette, mute your mic.
So from finance lease agreements, for example, for the assets you have leased, to whether they are paying for them, yeah? So here you're testing for completeness. So when you're moving forward, as I told you last time, for inspections on this diagram, we said when you start from the source documents to the accounting records, you are testing for completeness and accuracy. But when you move backwards, when you start by picking documents here and checking whether they have source documents, you're confirming whether the transaction occurred and whether, if it's an asset, whether it exists. Yeah, like that. Then for the inspection of assets, you can, for example, from physical assets to asset register to GL to statement of financial position, like that. Physical, you start by physical asset. So physically inspect the assets, check whether they are recorded in the register and the general ledger, and also the statement of financial position. Here you are testing for completeness. Testing for completeness, whether all assets are being recorded in the balance sheet, in the statement of financial. But you start with what is there physically. Check whether it has been recorded in the register, in the GL, and statement of financial position. You can even add PPE schedule somewhere here. Like that. But you can also reverse this test. You can also select assets from the GL and check whether they are recorded in the asset register and they physically exist. Test for existence. Like that. So those are inspections. Inspection of documents, you only agree documents. You only match documents. You only review documents. Inspection of assets, it is assets from asset to documents, or from documents to assets. And other tests. Now, I will show you these tests. The tests we have developed, these ones here, you're going to find that they are matching with what we have here in the notes. For example, how do we audit for completeness? These are the tests for completeness. We are saying that you're going to obtain or prepare a schedule PPE. Schedule PPE is just a list of assets, you remember it. You need to reconcile the cost the depreciation and the carrying amounts for each category. Remember, in the PPE schedule, there are different categories of assets. There's land, buildings, there's property, plant, equipment, and all that. So agree. We are agreeing. When you agree, that's an inspection, yeah? Agree opening balances to prior year, working papers or general ledger. So you get the schedule, look at the figures in that schedule, and those figures, you analyze them, you reconcile them, you confirm that they are the correct ones, and then agree. So, like for example, the opening balances, you're agreeing the opening balances the prior year. So you get two schedules. You get the schedule of the current year and the previous year. So the opening balances of the schedules in the current year, you compare with the closing of the previous year, or you agree like that. It will show you whether those opening balances are the same or they are different. The opening balances, for example, in the PPE schedule, you always have the opening balances with the cost for each asset, the opening balance of accumulated depreciation, then you get the opening carrying value. Then the second test for completeness, you can see this test is moving forward and it is testing for completeness. Then we are going to go to the general ledger of assets, general ledger, and that general ledger, we are matching it with the register. Asset register is here. And the closing amount of the schedule is the general ledger balance sheet. So reconcile the PPE accounts. PPE has different accounts. You find their land account, you find buildings account there, plant account, and many other accounts. So those accounts, you're going to first of all reconcile them, add them, whether check whether they add up. Then also look at accumulated depreciation accounts in the ledger. So reconcile them. You're reconciling these ones with in the ledger and asset register. And then the closing amounts in those accounts, you reconcile them with the schedule, because we pick from these accounts, take the schedule, the closing amounts. So it is schedule, general ledger and statement of finance. You can see we are moving forward from schedule to general ledger to statement of financial position. So in simple terms here, you are starting from the PPE accounts, PPP accounts, then comparing them to or agreeing them with the asset, the general ledger, those individual accounts. So there is asset register to the PPE accounts, to the general ledger, and then to the PPE schedule, and finally to the statement of financial position, like that. You start with the register. These assets in the register must be posted in the accounts. Remember, when you buy like land, you record it in the register. Then from the register, you debit and credit. You debit PPE account, you credit cash or bank, or even credit. Then you add up these accounts. When you add them up, they form what we call a general ledger. When you add them up, they give you the total. The total, you take it to the general ledger and to the PPE. And then that total also ends up in the balance sheet. So that's why I'm saying that you're going to reconcile these accounts with the general ledger and asset register, and the closing total amounts of the schedule with the general ledger and the statement of financial position, like that. Now, this one I've already talked about it. Remember, we are auditing completeness. Completeness, the tests must be starting from the first documents, the last documents. We are physically inspecting a sample PPE and tracing it to the asset what? Register. So from physical to asset register, you go and look at the physical assets. You look at a motor vehicle, then you ask for the register and check whether it is there. That will confirm that they have completely recorded that those assets, yeah? So physical assets, asset register, and balance sheet here. And then for leasing, for leased assets, the first document for leased assets, we have the lease agreement. So you start from lease agreement. Then in the lease agreement, you'll find all the terms and conditions, how much they're supposed to pay, when. Then you compare these lease agreements with the payment schedule for PPE, the payments they're making. You first get the agreement, then you pay. So the schedule, and then afterwards the balance sheet. So you are checking whether the payment schedules are in line with the lease agreements. That will confirm if they are paying for the asset, that means they acquired that asset existing. If it was not existing, they would not be paying money to the leasing, to the lessor. You get it? So provided they are paying money to the lessor, the asset is there, and also the completeness of the payments. Are they as per the agreement? The payments must be as per the agreement. So you are checking completeness of these payments. They must be in line with the agreement. Then inspect repairs and maintenance accounts. So this account, remember, it's a revenue account. You get it and you inspect it. Inspecting it means checking it. Confirm that in that account there's no any capital expenditures. There should only be revenue expenditures. So that will test whether all the capital expenditures are being capitalized and the revenue have been expensed to avoid overstating the other. So that's how you test for completeness of these assets. When you look at all these tests, all these are inspection tests. Agree. We are seeing still this one, you're agreeing figures or concerning them. You're physically inspecting and then tracing to the register. You are reviewing the lease agreements and confirm that the payments are as per the terms in the lease agreement, so that those payments are complete. Then you are inspecting repairs and maintenance accounts to confirm that they don't contain any capital expenditures. That will confirm that they completely recorded the repairs and also the capital expenditures were completely recorded. Then existence. For existence, we said we move backwards. It is the opposite of completeness. The first test we can run here is the entity you are auditing always does an asset verification exercise. Like if you're auditing MOBS does an asset verification exercise every year, and they come up with a report. The report will have assets which are existing and those which are not existing. So you start by asking for that report. You ask them, did you do any of his asset verification exercise this year? They will say yes. You ask them to give you the report. Then you read that report or you review that report. That's an inspection review. And after reviewing it, you establish assets they have indicated as not existing, assets they have indicated as having problems and all that. So that's why I'm saying that obtain that report and read it and see. They did an asset verification, which ones are existing, which are not. And they have put a comment why, they were stolen, was they damaged, what is happening to them. So confirm the entity inspects all assets in the asset register annually. Not just keeping them in the register, but they must also inspect them. Before you go there, you the audit and they make a report. So you go and first look at that report. It will show you which assets are not existing at the business, or the ones that have been stolen, misplaced, and other issues. Then the second test, you are starting from the PP, you are selecting a sample of assets. Possibly from the register and physically. So this is a reverse of this test. We had a test up here, which was physical asset to register. Then this time it is from register to physical assets. You start with the register here. You get that register and see assets which are there. Then you ask the auditee to show you where those assets are. The first one you started by looking at the physical assets. Then they showed you whether they're on the register or not. This one, you start with the register and they show you those assets physically. They must be in good condition and they must be serially numbered in the register, but also physically they must have been coded. They must have those numbers. You've seen those assets with numbers, because that number on the asset is the one they record in the register. And that's how you can match them, the description. And then you're also going to reconcile the opening and closing balances, as we said. It can also show you existence of the asset. If the closing is the one that is carried to opening, that means there's no any change. There's no any asset which has been lost or misplaced. So it is still existing. That's why they're carrying the same figure. Also, we can, for income generating assets, for example, some assets are in remote areas. You find assets, the business is in Kampala, but the assets are in Koboko. And the auditor, you may not go to Koboko because they may not be there. So what do? You get the records of those assets which are very far, which you cannot physically inspect. Get their documents. For example, some assets may be with customers. You get the repairs records, the driver's salaries. For example, you go to audit and they have told you the car is in Koboko with the driver. So ask for the driver's salaries. If there's no any salary of the driver, that means the car doesn't exist, because they're saying this car is driven by ABC and he has taken it to Koboko. Ask for his payroll. If you find that they don't pay any driver, that means the asset is not there, they're lying to you. Ask for the repairs records. If they have not done any service for any car, but they're telling you the car is there, so they don't do service that car, that will be evidence that it may not be existing. They're telling you the asset is with the customer. Ask them the agreement with that customer. If it doesn't exist, then the asset probably is not existing. So that is what I'm about. For the assets you cannot physically inspect, ask for those documents that can easily show that the assets are there or they are not there. Then how do we audit rights and obligations to confirm that they have only recorded assets they own? We inspect the ownership documents. I talked about them at the beginning. So ask for the ownership documents and you look at them. Then also, like for land, they will give you the land title, but that land title might be fake. You, the auditor, you can do an external confirmation, write to the Ministry of Lands, ask them to verify whether this land is in the names of the auditee or of your client. Then they will tell you some assets, some documents of assets are held by lawyers. They have kept them with lawyers or bankers. You're going to write to the lawyers or bankers, ask them, say, I'm auditing ABC Limited, and they have told me you're the one who's holding their land titles, their logbooks for the cars, insurance policies, and others. They will confirm whether they have them or not, and that will be a test to confirm whether they actually own the assets. The vehicles must be used for company work. If they are not being used for company work, then they may just have borrowed them. Come and be there, and you look at them and you go. So those vehicles, are they being used for company work? That is evidence that they own the vehicles. For the mortgaged assets, they must be mortgaged assets. Those are assets we obtain from the bank pays on our behalf on mortgages. You can buy an asset on mortgage basis. So that asset, you go to the bank, for example, today you want to buy a car. The bank will pay for you the money. That's what's called a mortgaged asset or a mortgage. You want to buy land, the bank will pay for the land, then you start paying back the loan. That's a mortgaged asset. So how do you confirm that a mortgaged asset exists? You will review the mortgage register. The schedule, the payments you're making to the bank. If you are paying to the bank for a mortgage, that means you actually bought the asset on loan basis. Then for the leased assets, we're going to review the lease agreements. They are the ownership documents there, like that. So here we are reviewing the inspections here, most of them. We are reviewing the ownership documents. We are trying to review them to see whether they exist. So those are the tests For the additions for assets that were added during the year, you're going to get the breakdown of those assets and then agree to the register. Have they been added to the register and the general ledger? If they have been added, then that means it is true they bought those assets. And then also, we are going to agree the cost of those assets that have been recorded in the register and in the ledger with the supporting documents to confirm that they have recorded the correct amounts. But also, you're going to look at the supplier invoices and confirm that they are in the names of the client, the company you're auditing. Because they may say that they bought the assets, but when they're not in their names. So you look at those documents and confirm that they're in the names of the company you are auditing. And then for those additions, they must have all included capital expenditures. So you review the list and make sure there is no any repairs and maintenance. Because sometimes what people do, after repairing the building, they record it as an addition to the assets. Yet I-16 requires that cost to be expensed since it's a revenue expenditure. Then you must review the board minutes for the authorization of acquisition of the assets. The board must have authorized the acquisition of the assets and then physically inspect a sample of the additions, whether they have been added in the register and all that. Then for self-constructed assets, the assets the company has built for itself, they have not bought them, but they have just constructed them. For them, you can verify the labor, the material, labor, and overhead costs they have used to construct. The costs they have recorded for material, labor, and overhead must be compared to the invoices and the payroll that's for labor to confirm that they have recorded the correct amounts. And those are the tests. Then if there is a major overhaul of the asset, that must be capitalized. For example, you have a car and you replace an engine. So that one must be capitalized. But the minor ones must be expensed. And then for the costs, you must ensure that no profit has been included. We don't capitalize the profits. And then for IS-23, you cover this in accounting for the borrowing costs. You must also confirm that they have capitalized them in line with IS-23. Remember, in line with IS-23, there's where you suspend capitalization. So if during the year there were instances of suspending capitalization, then they shouldn't have capitalized that. They only capitalize where they're supposed to capitalize. For the disposals, when an asset is disposed, you check whether it was removed from the asset register. And then also, you check whether the accumulated depreciation was written off. You check whether the sales proceeds on that disposal are not recorded as sales, but rather as an addition to cost and credit in disposal account. And then you also check whether the profit or loss on disposal, you're going to recalculate it even, and it has been posted to the right accounts. Then also you confirm that the asset being disposed, the depreciation is stopped at the date when it was being disposed. And also the necessary disclosures must have been made for the disposed assets. So that is disposal measure. You confirm it has been removed from the register. You confirm the profit or loss has been computed and posted correctly. You confirm that the disposal was authorized by the board. You confirm that the proceeds are not recorded as sales because that's not a normal sale. You remember the double entries, you debit, cash, or bank, and credit disposal. You also confirm that the accumulated depreciation has been written down for that asset, and then the disclosure has been made in the notes. So those are the tests for assets. You go through these ones when I send you this. Any question on that? We shall go to the next asset, which is the intangible assets. How do we audit intangible assets? Now, intangible assets, we are looking at IS 38, basically. And if you remember IS 38, it has intangible assets which can be purchased or internally developed. Assets like goodwill, they are purchased intangible assets. You purchase a business at a higher cost than its fair value. You remember it in IFRS 10 consolidation. Remember it in IFRS 3. So what are we saying? We're saying that when you buy an asset at a higher price, you pay for it more money than its value, than its fair value, then the difference is goodwill. Or these assets may arise from internal research and development exercises. For example, when you develop a website for yourself, that's an intangible asset, and it has been internally developed. So there is R&D expenses. You remember them in IS 38, research and development expenditures. You remember IS 38 requires expense of research costs, and it requires capitalization of development costs. But they give you guidelines on when to capitalize the development costs. So we're going to check all that. So which test do we begin with? We can begin with an inspection. For example, for goodwill, we said it arises when you purchase assets or a business on a going concern basis, and the price you have paid, the purchase consideration, is more than the fair value of the asset. The asset is 10 million, but you pay for it 12 million. There are reasons why that one happens. It might be in a strategic location. It might be having a reputation which you are paying for, that extra 2 million, which is goodwill. You're buying customer lists, you take over business. Airtel buys Worried and they take over the customers. So they're paying you more money than the physical assets. So the difference is the goodwill. So how do we prove that it is actually 2 million? That actually the fair value of the business was 10 million, but we ended up buying it at 12 million. So we're going to look at purchase consideration in the sales agreement. The sales agreement will show us how much money you paid. But also we can write the other party to avail us with their balance sheet. What was the last value of that asset before they sold it? So the last value, if it is 10 million, then you paid 12, then it is true that the goodwill is 2 million. So that's why we say agree the purchase consideration to the sales agreement by inspection to confirm that value of goodwill. But also you do a reasonableness test. For example, you go to audit an asset and you find that it has goodwill of 10 million. But when you look at it, there are no factors that are bringing that goodwill of 10 million. They are not there. It is not strategically located. They didn't take over any customer. They didn't take over any workers. The name of the company is in the press. They're writing bad about the company. So you run a reasonableness test. You ask yourself, where is the goodwill of 10 million coming from in those circumstances? Then you can also recalculate goodwill to verify its accuracy. Remember, to get goodwill, you get purchase consideration minus the fair value of the assets acquired or of the assets at acquisition. You can also, now in IFRS 3, it requires us to impair goodwill or to check for impairment, to test for impairment, to test whether this goodwill, if we bought the business at a goodwill of 10 million, is it still standing up to date after 1 year, after 2 years? There are many factors that may impair that goodwill. We looked at them in IFRS 3. For example, changes in economic conditions. For example, some workers you took over might have left. The quality may not be still good. So is the goodwill still there? The market might be changing. So you test for impairment. An accountant is supposed to test for impairment. Now you, the auditor, you come and check whether the goodwill was tested for impairment. Because when the accountant and management test for impairment, they make a report. So you check whether they tested for impairment, and what they come up with there as the recoverable amount and the current amount, and check whether there's any impairment, loss or gain, which should be recorded in the profit or loss. So that is for goodwill, that's how you audit it. Then for these other intangible assets we develop internally, I told you IS 38 requires that research expenditures are expensed. So you're going to check whether the research expenditures were expensed in line with IS 38. 2, you're going to check whether the development costs were capitalized in line with IS 38, but IS 38 requires capitalization of development expenditures only when the directors are confident that the asset will be completed. For example, if you are auditing a pharmaceutical, they're developing a COVID vaccine. Now, when do we start capitalizing that COVID vaccine? We start capitalizing if the directors become confident that one, the asset will be completed and it will be ready for use or sale. Then it is technically feasible to complete that asset. They have intention to complete, and also the asset will generate future economic benefits and the cost can be measured reliably. Other than that, we don't capitalize the development costs. We only capitalize them when the directors become confident that the asset will be completed. So you check for that. When did they start capitalizing? At that time, were the directors confident? Were all these criteria followed? You get it, that one. Then also you can compare the budgeted and the actual, because in these developments, they can also steal a lot of money. So you compare what was budgeted and the actual, find out if there are any significant increases and whether they are justified. But also you're going to recalculate the amortization. Remember, these intangible assets are amortized, you get the cost divided by the useful life. So you recalculate the amortization and check whether IS 38 requires it to commence with production. So did they commence it then? That is what you think about. Then to confirm that the correctness of the research and development costs or expenditures, you're going to inspect the invoices. They should record the values on the invoice. That is what you think about. Then for other intangibles, there can be like patents, like copyrights, and many others. You're going to agree the purchased intangibles to agreements by inspection. You're going to inspect the value by experts. For example, if you have copyrights, the expert will value them all patents. They must leave a report. So you review that report, you look at the basis they use it to come up with those values. But also you can recalculate the amortization costs to verify accuracy. Any question on intangible assets? You just have to remember IS 38 and you just use these words: agree, check, recalculate. Most of them are inspections since they are documents here. We got audit of inventory. Now for inventory, now somebody is asking, how does R&D be an intangible asset? IS 38. When you do research and development, you develop intangible. We do R&D to develop intangible assets, such as websites, such as softwares, such as vaccines, such as medicine. Those ones lead to intangible assets, like a software is an intangible asset, as a website is an intangible asset, and others. So we are saying that when you incur research and development costs, they lead to intangible assets. That one you are taught in IS 38. in accounting 3. So that's how R&D leads to intangible assets. Audit of inventory, this is IS2, we're going to audit IS2. Here we are focusing on R&D that leads to intangible assets, not to machines. For machines, that will be a different standard, that will be IS16. In IS38, we only focus on R&D that leads to intangible assets. If it leads to tangible assets, that is IS16. IS2, who can remind us what IS2 is all about?
Inventory is measured at a lower of its net realizable value, and
Yes. IS2.
IS2 looks at inventory and says that inventory should be recorded as a low of cost and net realizable value.
So inventory in IS2, we look at raw materials, look at work in progress, and the final or finished products. That's majorly the inventory look at.
Inventory is measured at low of cost
And then from there we use FIFO. It allows use of FIFO and weighted average cost method to determine the value, but also standard costs. Remember in cost accounting. Then also measurement. Initially it's at cost, initial measurement, but subsequently it is low of cost and NRV. So measurement, lower of cost, and NRV. Then closing stock. We said this is, you must do a stock take. Do a stock take and this can be done periodically or at the end of the it can be done during the year or at the end of the year, stock take. Then write-off, obsolete inventory. These are some of the requirements of IS2. Then they give you what to put in the cost. So the components of cost, and then NRV are also given. Then their source documents. Then we have the inventory count instructions. When you're counting inventory, the instructions you must follow. Then disclosures, there are disclosures you must make in line with IS2. So these are some of the few things in IS2. It talks about what inventory is, how you should arrive at the value, the methods that are used, they only use FIFO and the weighted average cost. Measurement is a law of cost and NRV. Then if there is a loss, it must be written down. If there is a loss in inventory value. That is if you find when NRV, when cost is greater than NRV, it's written down with board approval. Yeah. Then we're taking also, we're also saying that we must have a manual, policy manual for inventory. It will show us how inventory is recorded, the stores, how they're supposed to be arranged and all that. Insurance must be there. You get it. Then inventory valuation report at the end of the year. Yeah, and after the count, after stock taking. Then also the final stock list must be there after the count. You get it. So these are some of the few facts in IS2 which you looked at last semester. This is what we're going to use to audit. Now, for example, if I start with the first one, comparisons, I can compare the closing stock for the current year with the previous year. What do I want to establish? I want to establish any significant increases or decreases. If closing stock is increasing, then there's a problem. We are not selling our goods. Now there is a ratio here, there's inventory turnover. I will compare inventory turnover for the current year with the previous year. So what am I comparing? I've started my test. I started with comparing total closing stock for the current year with the previous year to establish any significant increases. The problem is when closing stock is increasing, meaning maybe our production has a problem, you get it. Also, I'm comparing the inventory turnover ratio or inventory period, you get it, for the current year with the previous year. If those days we hold inventory are increasing, then there's a problem. So compare the inventory period for the current year with the previous year. Establish any significant increases. So inventory turnover period is the number of days inventory remains in the store or remains unsold. Yeah. So if inventory is remaining unsold for a long period, then there's a problem. Inventory is likely to expire in stores. Yeah. Increase. Test for. This one can test for which, for completeness, for what? What does it test? For valuation of inventory. Because if it overstays, then it should be written down. You get it. But there's a risk that inventory has overstayed and it has not been written down. So there's an issue with valuation. I'm going to obtain insurance policies to confirm whether inventory is insured. You get it. So obtain insurance policies to confirm that inventory is insured. And if inventory is insured, that confirms existence. So it is a sign that it may be existing. Yeah. You're going to review the financial statements and confirm that the necessary disclosures in line with IS2 have been made. You're going to review the inventory valuation report and confirm that, like that. So that is just a teaser. We go to the actual tests here and see. For inventory, it's an item in the balance sheet. So what are we auditing? We're auditing existence, whether it existed, but also current, since it also appears in the profit or loss. Remember, inventory appears there. We purchase goods and sell them. We're testing for completeness of inventory. For rights, do we have rights over that inventory we are recording? Cutoff, has the inventory been recorded, like for the purchases, have they been recorded in the correct period? Remember, inventory comes from purchases. Then for all sales. And then accuracy, and then presentation. It must be in line with IS2. So these are the tests for year-end inventory count. At the end of the day, we count inventory. At the end of the day. So how do you audit that exercise of counting inventory? You get it? They are counting their inventory, and for you are auditing. Occurrence is not the same as existence. Occurrence is you are proving whether the transaction took place. Existence is you are proving whether the asset exists. So the two are totally different. Occurrence is for incomes and expenses. Existence is for assets, liabilities, and equity. So for the count, how do we audit the inventory count? Capital Shoppers is counting the inventory that remained at year end. As auditors, we must be there to audit that process. You're going to observe the physical inventory count. You go and see, are they actually counting or they're not counting? Then, after they have counted, select a sample of items they have from the records and physically inspect them. Remember, it is existence. So from the stock lists, get a sample. Say, I want you to show me item A, B, C, D. They will show them to you physically. Then, some inventory might be with third parties like our agents sub-country. So that inventory with agents, you can inspect the documentation because whenever they're taking there, they first record it in the documents. For completeness, you count items physically, then you trace them on the final inventory lists. They must be recorded there, all of them. Then in our stores, we might be having goods, but those goods are not ours. They're for other people. Somebody bought his goods, but he left them in our stores. So we look at those goods physically, and then I will write to those people and ask them, we are auditing this company, but there are some of the items that saying that they are yours. That person will confirm or not. So physically inspect the goods held by third parties. There are goods held for third parties and those held by third parties. Those held by third parties, they are our goods, but in Imbali. Somebody else in Imbali is having our goods, our distributor there. We want to confirm whether those goods have been completely recorded. So what do? We can go to Umbala and physically inspect those goods. And then, or we can write to that person to send us a confirmation letter that they hold those goods and the amount they're actually holding. That will help us test for completeness. Then also, there's a gross profit margin. It will help us, we compare for the current year and the previous year. It will help us to know whether we are selling our goods at a profit or at a loss. If it's at a loss, then there is a problem. They taught you consignment stock last year. Consignment stock is stock which is held by the agency. So the whole issue is, do we have rights over that consignment stock or not? So you can inquire. They may tell you some of the goods you have already bought them, but they're still in transit. So inquire about the goods in transit or consignment stock. Consignment stock, I've said, or inventory, is inventory held on behalf of another person. You're holding inventory on behalf of another person. That is consignment stock. They have sent you some goods, but you're holding them on behalf of the other person. Either you're selling on his behalf, that's the most common scenario, you're selling on the other behalf. You're an agent of somebody, yeah? So we can inquire about them, whether actually these goods in transit or consignment stock are there. We can inquire from management, because you'll find when they have recorded them in the records. So inquire, then also inspect the documents from the supplier. It will show you that those goods are actually coming or they're not coming. And then for consignment stock, whether actually you have control over it, whether you are the one bearing the risks and rewards or not. Then you're going to identify, there might be goods held for third parties in the store. In your store, you have goods, but they are for other people. So how does the auditor confirm? You look at those goods as an auditor, and you must confirm that they are put in a separate place. They must not be mixed with the goods of ABC Limited you're auditing. And they must not be included in our inventory. So the goods, they tell you that these goods, the customer bought them and left them here, confirm that they are placed in a different place, or they are stored separately, and also they are not included in the inventory. And then also, you can inquire from management on stock being used as collateral. You know, some stock can be used as collateral to borrow. Some companies have stock which takes long to be sold, so they can use it as collateral. So inquire from management and review the loan agreements for the stock used as security, because there might be a risk. If there's no clear documentation, that stock can easily be taken in case the business fails to pay back the loan. Then for cutoff, you want to confirm that the stock is recorded in the correct period. That's if it is under profit or loss in form of purchases. You're going to look at the dates of the GDN and GRN. So those dates will guide you. GDN is the goods dispatch note, and GRN is the goods received note. GDN is for sales. GDN. If GDN has 31st December, that means those goods were sold on 31st December. They should be deducted from our stock at year end, because it is a GDN date we take. Remember IFRS 15. IFRS 15 revenue from construction contracts. We said that our sale is recorded when goods are physically transferred to the customer. Then a purchase is recorded when goods are received. But which document transfers the goods? Goods dispatch note. Which document receives the goods? Goods receives note. That's why I'm saying GDN is for sales, GRN is for purchases. So when you look at the dates of these two documents, they will show you when the sale actually happened and then when the purchase happened. You don't look at the invoice, because an invoice sometimes comes later after the goods have already been taken. So you follow IFRS 15, the sale must, or the purchase must be recorded when goods are physically transferred. And these are the documents that physically transfer goods. They will show you whether the stock is recorded in the right period or not. Then for valuation, allocation, and accuracy, you want to confirm that inventory is correctly valued. Then you're going to compare the inventory quantities to the final inventory list to the auditor's copies of the inventory. Now, when you are attending the count, you get your own copies of the sheets. You can't attend the inventory count when Capital Shoppers is counting its inventory. You'll get your own copies. So at the end of the day, you're going to compare your copies with those of the company they have come up with the final list. Compare the quantities on those lists. The quantities must be matching. If they're not matching, then the valuation has a problem, or the accuracy. And then for the cost sheets, you are going to obtain the cost sheets. Those goods have costs. So have they based them on the standard costs? So get a sample of finished goods and work in progress, and confirm that they have used the costs on the invoices, those they have just bought invoices. And then for the, if you're a manufacturing firm, they must have done the manufacturing account. You remember how to do manufacturing account, and they have put all the direct and indirect expenses. They have added them so well to determine the cost of goods manufactured. Then make sure that you agree. Sometimes you have the opening work in progress. You remember the manufacturing account. Work in progress means incomplete goods. So the incomplete goods you start with, you're going to agree them to the work in progress schedule you develop, and agree them to the percentage completion record. This work in progress at the beginning. By the end, have we completed these goods, or they are still incomplete? If they remain incomplete, there's a risk that they can be broken, they can they can lose value. Yeah? So that's why you're getting the work in progress at the beginning. Then also get work in progress at the end of the year. The goods you started with are incomplete. By year end, they should be complete. The new work in progress should not involve the old one. That's what we're trying to test. And then you make sure standard costs are used. You remember standard costs from cost accounting. And they must be reviewed annually. And then you confirm that they are valued at the low of cost and net realizable value. So check whether inventory is valued at the low of cost and net realizable value. In case there is aging inventory, you confirm that has been written down. Aging inventory means inventory that has overstayed. When inventory overstays, it loses value. So confirm that it has been written down. If you bought an item at 1 million, but it has taken a year without being sold, it is no longer 1 million. It has lost value. So even in your books, you must ascertain the value it has lost and you write it down. And then for inventory days, compare with the previous year and the current year. This is an analytical procedure to confirm that if there is any increase, this is problematic. It means inventory is staying for many days, which will lead to loss of value or obsolescence. I already talked about gross profit margin. Then for presentation, it must be presented in line with IS2. So these are tests for inventory, how we test whether inventory exists, how we test whether inventory is completely recorded, whether we have rights over it. For the consignment stock, we must be having the documentation showing that we are holding inventory on behalf of the manufacturer. We are agents, we are holding it on behalf of the manufacturer. For the goods in transit, we must be having documents from the suppliers. Because when you're buying goods from China, you do have documents, of course, letters of credit copies, the FOB you've started purchasing, you remember these documents, to show that actually goods are on the way coming, the bills of lading and others. Then for goods of the third parties, also sales agreements will be there, that somebody just left here his goods, but actually they're not ours. And then for the pledged inventory, the bank will confirm. For the cutoff, you look at the dates of the GDN and the GRN. For the existence, you start with documents and you check whether the inventory is there physically. For completeness, you start that's for completeness. For observation, for existence, you start with the looking at the documents and then checking the physical existence of the inventory. So the next time we meet, we are going to start from here, inventory count. How is an inventory count conducted? That's where we shall start from the next time we meet. Enjoy the rest of your day, in case there are no any questions.
The rest of that, send for thank you, sir.
Welcome, have a good day. The notes, I'm going to share the notes.
Okay, sir. We
Okay.
are waiting.
Okay.
You share the notes with all the changes you've made.
Changes, there are no any changes. These are just explanations.
Yeah,
I mean,
with
explanations.
Okay.
At least we've got everything.
Thank you so much for watching. Make sure you subscribe to the channel.